What do you think? Do we continue to have gains? And we had them across almost all asset classes in 2019. Do we continue to see these gains in 2020?
Hi, Matt. Thanks for having me on. I think the key thing is that we will likely see continued gains, given that we've had a lot of the tensions, a lot of the challenges that were facing us in 2019 has been lifted in 2020 so far, at least. But we shouldn't expect to have the kind of magnitude of gains that we had last year. And we could see a slight tilt in the regional performance. So, for example, we're expecting the emerging markets in Europe to outperform the US for this year, which is a different aspect to what we had in 2019.
Yeah, that's interesting. Seema, good morning to you. Happy New Year.
Happy New Year.
Let me ask you about where Europe sits then, because this is a chart of European stock gains over the past decade, year by year, and it just puts into context. 2019 for European stocks might not have been as good as it was in the US, but it was very good compared to recent history, wasn't it? So do we expect, where do you stand on that story around European stocks at this point?
Yeah, well, look, we really like European stocks. We think last year, actually, across all equity markets, a real big push was actually just that central bank accommodation, that real flood of liquidity. And ultimately, that liquidity means that risk assets should continue to perform. From the European standpoint specifically, the macro performance we see stabilizing, at least a slight improvement. We think that there's going to be greater pressure for the fiscal policy stimulus to come through. We don't think it's going to be very significant, but at least there's a positive movement. So those things, as well as the slightly more attractive valuations of European equities compared to US equities, we think should see European equities perform decently.
What is we're still going to see a big spread, Seema, I assume, between the U.S. and European equity valuations. Do you think that contracts?
I think it contracts a little bit. I mean, ultimately, for the US as well, we're not expecting a bad performance. We still think there will be gains in the US as well. But given the richness of US equities, we think that valuation gap will close a little bit. But, a lot of it is going to be depending on how the US elections, how that progresses through the year, and also making sure that US-China dissolution of those tensions actually doesn't come back.
Let me ask you about, you mentioned something in your notes which made me smile, Seema, this morning. We know that expansions don't necessarily die of old age and stock rallies don't necessarily die of old age, but do they get vertigo? Because you ask in your notes whether equities are going to suffer from vertigo in 2020. From what you've said already, it doesn't sound as if you think so, but I guess many investors will be reassessing the gains that we've seen in 2019 and asking really whether they have the stomach to position for further gains.
Oh, absolutely, and I think that's really, really key, because what we've had pushing equities, as I said, is that central bank liquidity. It's not really a very strong economic environment. So although we see stabilization in growth, we're definitely not expecting a very strong boom by any means. So what we have is that very significant disconnect between stocks and the fundamental economics continuing to widen. And that widening means that investors over the progress of the year will start to get even more sick about that. What is this really based on?
Is it buybacks is the sort of lazy explanation for all of that? Is that too lazy? Is there a lot more going on?
No, but I think that is there is a lot to say for that with buybacks, and actually, we like financials, we like technology for this year, because of that buyback story. But ultimately, as soon as you have that central bank liquidity, making sure that we know, and certainly we don't expect a recession on the horizon either for this year, that means that investors, there's no reason to be in cash. You should be fully invested, and that continues to push up risk assets.